Hey guys, welcome back. Joe here from 9 to 5ers, and we're going to be talking about a topic that might be blowing some of your minds. It might be something you've never heard of. This might be kind of like just a refresher course, but self-directed IRAs versus traditional IRAs. And we're going to be comparing and contrasting. And if you've never heard of a self-directed IRA, please put that down in the comments, and maybe I can create a video down the road that explains what a self-directed IRA is in more of a detailed concept here. So we're going to talk first about what an IRA is, and we're going to get on the same page and make sure that we're all talking about the same thing here, at least in the basic understanding of it. We're going to do a pros and cons list of an IRA, and this is going to be a pros and cons list versus a self-directed IRA, not really compared to anything else. What is a self-directed IRA? We're going to explain that too, and then we're going to talk about the pros and cons of a self-directed IRA. We're going to compare the two, just kind of like in a summary. And then we're going to do some takeaways and maybe some action points that you can jump out and get started, maybe even today, as early as today, for sure. So an IRA explained. What is an IRA? Well, an IRA is an individual retirement account. And this is also known, this is the generic term for a 401k plan, a 403b plan. It can be also known as a Roth. A CISA is a type of individual retirement account, and also a solo 401k. They're all under that umbrella. And we're going to compare these two. Just remember that a self-directed IRA can come in the form of any of these things as well. So it's a generic term there. So what do you do with an IRA? Well, you send your money through either your paycheck or a direct deposit, however you want to do it, to a custodian. And the custodian is your Schwab, Merrill Lynch, one of those giant companies that basically manage people's money. And then they put the money to work for you in securities, and then you review and adjust your portfolio as you see needed. You can be taxed now or you can be taxed later, and this is going to be the same for a self-directed IRA. And we're not going to get too much into the taxes on this because it is pretty much the same either way when comparing these two products. You can invest in stocks, bonds, mutual funds, and ETFs. So what are the pros of owning or using an IRA? Well, IRAs are big time hands-off approach. You are not an investment savvy person. You don't really care about the stock market. You want to invest for your future, and you want to grow your money without having to work your entire life, but you don't really want to listen to conference calls or watch the stock market every single day. You basically fund it and you adjust it. You adjust it based on what you think you should adjust it on. You do it based off of what the custodian says that you should do, or a combination of both. Fees are pretty reasonable because everybody's out there fighting for your dollar, and there's a lot of competition for that. And they're just trying to lower their fees to get your business versus somebody else's business. Cons. Your investment choices are extremely limited. And I'm saying this in comparison to self-directed IRAs, which we'll see a little bit later on. There are management fees, and this really has to kind of focus on mutual funds. They have the ability, since they're actively managing it, they can pull extra funds out for themselves if they hit a certain target. So that could potentially limit the amount of return on investment that you can get, because they are taking some of the excess profit for themselves. And there's limited growth with an IRA. And the reason why I'm saying that is that you are, you're going to get basically whatever the market is allowing you to get. And now you might say to yourself, well, if I choose my stocks differently and I invest in this and I invest in that, and I take on a lot of risk, then I could outperform the market. Yes, you can, absolutely. But with that reward becomes the potential risk on the other side of the coin as well. And what we're saying here, for argument's sake, is that if you're going to invest in the stock market, you're basically, for lack of a better term, going to get what the market is going to give you. And you really, really lack a lot of control. And by lacking a lot of control, what I'm saying is that you get to pick from the investment choices of, say, whatever the companies, whatever your custodian is providing. But it's also saying is that if you own a little bit of all these different companies, you still don't have any say in what that company is going to do. Like, yeah, they have voting shares and what have you, but you don't really get to decide whether Coca-Cola goes and invests in a plant to open in Idaho or not. I mean, it's basically you don't have any control whatsoever in the business. So a self-directed IRA is basically an industry term. And what they're saying is that the custodian is very, very hands off. In other words, they are only going to do what you tell them to do, and they are not going to give you any advice whatsoever. They are going to just move your money around, make money go into your account, move out of your account into an investment, or you can take the money out of your account completely. They're not going to give any sort of investment advice whatsoever. They are there to just move the money around and make sure that you stay legal. So you have way more investments to get into versus an IRA. And let me just kind of explain this here with what I created. Mutual funds, stocks, bonds, and ETFs. Okay, well, that's everything you can do with a regular IRA, yes. But you can also invest in commodities, so gold, silver, palladium, platinum, and you can also invest in real estate, and that could be basically anything you can do in real estate. So buying and holding, flipping. You can buy and sell notes, which is basically paper that's the debt on it. You can get into a small business venture. So anybody that you know that is not a disqualified party, you can invest in a business venture that they may have. So if you know a guy that wants to start up his own tire change and oil replacement center, and he needs like $200,000 to do it, and you're just like, hey, I'll come in at 50%, and you just run the business and I get half of the business, and if that business skyrockets, then you can become a millionaire very quickly versus investing in Pepsi, and it's going to be very tough to turn 200,000 into $1 million because of their lack of growth. Basically, they're kind of at the maturity of their business cycle. You know, Pepsi's not going to quadruple or quintuple in size, within a year or two, but a small business can. Cryptocurrencies as well, all types of cryptocurrencies. You can do private lending to people. You can invest in land. You can invest in tax liens and deeds. So tons of stuff you can invest in here. And you can also be taxed now or taxed later, depending on what type of account you set up. And you are very, very hands-on. The custodian is hands-off, so that means somebody's got to be hands-on, and that's going to be you. So you're going to be creating loan documents. You're going to be doing due diligence on the types of investments that you are looking to get into, way more than just listening to a conference call once a quarter talking about profits and losses and cash flows. I mean, you're going to be on it, and you're also going to follow up with the process on the investment. If you're going to go to that, if someone's flipping a house, you're going to go to the job site and you're going to follow up with them, make sure that they're on their schedule, that they're following through with what they said they were going to do, and there's any issues they're being taken care of. Self-directed IRA pros and cons. So the pros are you have way more control, the terms and the knowledge. So let's just pick real estate for an example here. If you understand flipping to a degree that you could go out there and find a deal and execute it and make it happen, then your knowledge is, you're already there with that, and you understand flipping way more than the average person understands about like Pepsi or ExxonMobil, what they should be doing, what they shouldn't be doing. And you can also dictate the terms of the loan. How long is the loan going to be for? What's the interest rate? Are they going to pay points? Is it going to be interest only? What happens if the deal goes south and then like what happens then? Like, what are you purchasing it for versus what it's worth on like what it's actually worth? Are we buying at a discount right now? What is the eventual sale price of the property? What are the comps? You have way more control, way more knowledge, hands down with a self-directed IRA because you are investing. And that you have it, but it's up to your discretion to use that control or the control in the terms and the knowledge. People can be very foolish and not do their due diligence here either. And you'll see that on the con side, but you can, if you have the knowledge and the terms, you can make it happen. All right, enough said. Way more options to invest. We don't need to say that again. And you can still do your custodian, your self-directed IRA custodian is going to offer you options like a health savings account, a Roth IRA, a traditional IRA, a solo 401k, or a education account. You can set all these up, and you could set up one of them or you can set up all of them. So you could have your own HSA set up for yourself and and pay for health expenses while flipping properties, which is pretty bananas. Legacy creation. And the reason why I came up with this is because I was watching a video on this, and the guy said that he was a custodian, and one of his clients, they had, I don't know, I can't remember what it was. I'm going to paraphrase here, but they were making $100,000 a year in rental income off of properties that they owned in their self-directed IRA. And then what they can do is when they pass on, they can, in their will, give that to their children. And now they have $100,000 worth of income coming in from properties, which is great. So you can pass that on, and then the kids can grow it and keep going and going and going. The cons are, don't open one unless you intend to use it. And by use it means this is not a set it and forget it type of thing. I mean, yes, you can invest in stocks, bonds, and mutual funds, but the whole purpose of this is to have a self-directed IRA is that you are going to be doing the more alternative stuff, the real estate, the cryptocurrencies, the notes, the buying tax liens, whatever your knowledge base is in. If you're just going to set one up and then just let the money sit in there, then the fees are going to eat you up, and it's going to be a complete waste of your time. And you're going to be more hands-on. This is kind of a pro and a con. You have to do the work. You have to know what you're doing. It's less passive than just a traditional IRA that you would set up with a company. I mean, you have to vet the deals. You have to follow up, making sure they're making their payments on time. There is more work involved with this, but you're also expecting a higher return on your investment as well. And you cannot be directly involved. And that is one of those things where it's kind of weird, but if you worked at Pepsi, you could buy Pepsi stock and you're working at the company, which through your 401k, and that's like no big deal. Okay, but if you have a self-directed IRA, you cannot buy a property that needs to be flipped and then go out there and work on it yourself. The tax man's going to find out about that, and you're going to get slammed with a bunch of taxes and penalties, and it's not going to be a good time at all. So you can't be directly involved in the day-to-day operations, hands-on type of person. It's basically you're investing in something else that you are separate from. And there are things which are called disqualified parties. I kind of mentioned that. You can invest with family members, and that also has to do with people that like your mother-in-law, father-in-law, brother-in-law, that type of stuff as well. So, but that's more of a thing that the self-directed IRA custodian can ask you and follow up with you on that to kind of keep you out of hot water a little bit on that. But just know who you can invest with and who you can't with. If you're related to them, you can't invest with them. And there might be a learning curve, maybe. And I would say that I personally, I've never flipped a property, but I understand vetting real estate and knowing the value of it and how much it costs to do this, that, and the other, because I've done plenty of rehabs myself. I've just never actually flipped a property. So if I wanted to get into flipping with somebody else, I would have to understand my learning curve would be much smaller than someone who has no idea, that's only watched flipping shows on HGTV. So depending on what you're investing in, there might be a learning curve to it. All right, so let's compare the two, self-directed IRA versus the IRA. So self-directed IRA has control. You have control of the terms. And IRA, they write the rules. Whatever the business wants to do, that's what they're going to do. They're not going to call you up and say, hey, do you want a bigger dividend? They're just going to say, hey, we're going to increase our dividend, or we're going to cut our dividend, or we're going to keep it the same. Investment options maxed out. And by I'm saying that is that you can pretty much invest in anything that's tax sheltered that you legally can invest in through a self-directed IRA. Traditional IRA, you get traditional IRA choices, and you get what you get. Risk to reward is more based on skill and knowledge of what you're focusing on. So if you understand real estate investing when it comes to landlording, let's say you've done it for 10, 15 years and you understand it forwards and backwards, you know what a good deal looks like. And you will probably you have a better chance of making a lot more money than someone that has no idea what they're doing. Your risk to reward is based off of market averages in an IRA. Self-directed IRA, they're not going to give you advice at all. It's all on you. And then with a traditional custodian, they might give you some advice. They might say, hey, this looks better, this whatever. The self-directed IRA, their fees can be higher depending upon performance, depending on your performance. And what I'm saying by that is that they're going to charge you a percent to of what your account balance is. So how much if you have $1 million in there, it might be like, say, less, like 0.5%. But generally, your self-directed IRA fees are going to be higher if you're comparing them to a traditional IRA. But that is also dependent on performance. That 0.5% could be a lot of money to you, or it could be next to nothing to you, depending on how well you perform inside of your self-directed IRA. And traditional IRAs, the fees are lower, but so are the returns as well. And now let me just give you a quick case study here on, let's just say that you have an IRA and you have $100,000 in it and you get a return of 10% in the market, which is pretty good. So $100,000, 10%, you just made 10 grand that year. Great. And let's just not add in the fees, but today they're lower. Great. All right. What if you had a self-directed IRA and you had $100,000 into it, and you know somebody that knows how to flip houses, and they flipped, we'll say that they flipped, you had $100,000 and you invested in the full amount of money into it every single time. And they brought you a profit of an average of, we'll say 20 grand per flip. And they flipped it 4 times. They did 4 flips that year. So you have $80,000 in your self-directed IRA. Even if you have higher fees, that's not even going to come close to what your profit was you were going to make in a regular IRA. Those fees will not touch that. You will still be way, way far ahead. $80,000 versus $10,000. So that's why I put depending on performance of your investing as well there. So some takeaways. What can we do? Ask yourself, what type of investor are you? Are you a passive investor? Are you an active investor? Do you want to get involved? Do you not really care? Do you just want to put your money to work and that's it? Or do you really want to see what you can really do? Do you have the time to vet deals? Are you working 2 jobs? Then you probably don't have the time to vet deals. Or are you a full-time investor and you have time to vet deals and you have the knowledge to? Do you have the knowledge and the skill set to vet deals? Have you picked something in that self-directed IRA field that you can okay, I think I have a distinct competitive advantage over somebody else when it comes to knowledge and know-how of this. I think I can make a better return on my money versus any of my competitors. What type of life and lifestyle do you want to live? And by that, I'm saying is that if you do the regular traditional IRA, you're going to have a way more passive focus on the investments, and you're going to have less work involved, but you're also going to get a lower level of lifestyle when it comes to income and money versus someone that actively goes out there and vets deals and takes up some of their time. That self-directed IRA person should be making 2, 3, at least twice as a return as what you're going to get through a regular IRA. You should be getting at least double whatever the markets are doing. So how do you get started? Well, find a self-directed IRA custodian and vet them. You are more than welcome to just do a Google search. I'm not going to give any advice on this now, even though I have one of my own. I don't want to promote them or sway you in any direction whatsoever. So do a Google search, find somebody that you know that has a self-directed IRA, ask them about their custodian, see what they think about it, and do some reviews online. And then when you got it narrowed down to maybe your top 2 or 3, ask them. Just like call them up and ask them. Just compare and contrast. It's their job to get your business. And you can roll over once you've picked one and you're ready to pull the trigger. You can roll over an existing IRA, an old 401k that's kind of been sitting there, and you can directly do it. So if you had like a 401k, you can roll it over to a self-directed 401k, or you can do what other people have done, which is they take an old 401k and they do what's called a pass-through account, and they basically take the hit on the taxes now, and then they basically turn it into a Roth IRA. So it's up to you on what you want to do. Talk to your accountant about that. He or she might be able to help you with that. And start investing. Guys, I hope you really enjoyed this. This basically introductory on an IRA or self-directed IRA. I personally love self-directed IRAs, especially the more you get to use them. And as long as they're working for you, they're great. But they're not for everybody. What stopped you in the past from reaching your financial goals? What types of videos would you like to see in the future? Please like, comment, subscribe. And if you're on Facebook, check us out at 9to5ers. Thank you guys so much. We are here to make you smarter today and richer tomorrow. Have a good one.